or have another print disability which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour I'll be reading from the Friday, July 24th issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. On the front page today, AI spending rips tech stocks. Concerns shave $890 billion in market value from the Magnificent Seven by Hannah Aaron Lang, Tina Lee, and Caitlin McCabe. Wall Street is reckoning with a new reality. The biggest tech companies are no longer cash printing machines. Concerns about Alphabet's and Tesla's earnings results spread to other major tech stocks on Thursday, with investors dialed in to the implications of ramped up capital spending, putting a dent in the artificial intelligence trade. Alphabet's shares slumped some 7%, costing the company more than $293 billion in market value, its largest one-day market cap loss on record. Shares of Tesla tumbled 15%, the stock's worst post-earnings performance ever. The sell-off extended to other tech stocks. Meta fell 3.4%, Oracle slid 4.6%. The Magnificent Seven erased nearly $890 billion in market value, the biggest one-day market cap decline since the tariff turmoil of April 2025. The Nasdaq Composite lost 2.2%. Both Alphabet and Tesla reported soaring revenue, but investors instead zeroed in on their AI spending. The phrase of the day, free cash flow, which turned negative at both. Alphabet's free cash flow came in at negative $5.9 billion, the first negative result since the company went public in 2004. The company's finance chief said free cash flow would remain under pressure as the company deepens its investments in AI. Alphabet also lifted its capital spending forecast to as much as $205 billion this year. Meanwhile, Tesla is spending big on its pivot toward autonomous vehicles and robotics. That includes building a chip manufacturing facility called Terafab, which Tesla is developing in partnership with Elon Musk's rocket space company, SpaceX, and Intel. Meta Platforms is projected to report negative free cash flow when it releases second quarter results next week, according to analysts surveyed by FactSet. Analysts expect the same from Amazon.com, which also reports next week and already saw its free cash flow dip into the red in the first quarter. The world's biggest tech companies, which came to be known for generating ample cash and stable balance sheets, are in the middle of a transformation. They have all bet their futures to some extent on rising AI use, investing in data centers that will make it possible to deliver the computing needed to process AI queries. Those companies are racking up unprecedented debt to fund their AI infrastructure plans. At the same time, cheaper open source AI systems threaten the business models of leading AI labs, whose computing and chip needs are driving hyperscale spending. Microsoft, which expects to double its capital spending this fiscal year, is alone among the big AI spenders, often called hyperscalers, in generating positive cash flow, with expectations for more than $16 billion in the June quarter, according to FactSet. Investors are genuinely concerned that these companies are in the midst of destroying some of the most successful, scalable, investor-friendly business models the equity market has ever seen, said Mike O'Rourke, chief market strategist at Jones Trading. That should be alarming. Free cash flow is essentially the money companies have left over after expenses and making big-ticket investments. It is different from net earnings, which spread the cost of major investments over several years through depreciation and amortization. Some analysts said free cash flow offers a clearer picture, albeit a bumpy one, of how much cash is available for things investors like, including dividends and share repurchases. The metric has at times been a defense against AI spending concerns. When skeptics have drawn comparisons between the current tech frenzy and the dot-com bubble of the early 2000s, Bulls have rushed to point out that today's spending boom is financed by proven companies with fortress balance sheets and buckets of cash. Now, those cash reserves are shrinking, and investors' patience for Silicon Valley's colossal spending spree is set to be tested. David Wagner, head of equities and portfolio manager at Aptus Capital Advisors, doesn't expect it to end soon. Everyone thinks it's going to slow down, where they're looking for the first company to blink on capex expectations, Wagner said. But this seems to be just the start. Also from the front page, oil roars past $100, threatens economy. Prices reach levels that could trigger inflation, pressuring GOP before midterms, by Benoit Morin, Alison Sider, and Sam Goldfarb. Oil prices roared back on Thursday to crack the $100 a barrel mark, an inflation-triggering threshold that threatens to bedevil the U.S. economy while putting pressure on the Republicans ahead of the midterm elections. As President Trump warned Iran could soon feel, quote, major military punishment, unquote, Brent crude, the global gauge, topped $100 a barrel for the first time since May. The U.S. oil prices shot up 6.2% to $92.19 a barrel. Higher energy prices quickly reverberated through markets, stoking a sell-off in government bonds that sent the yield on the 10-year Treasury note, a key barometer for borrowing costs, to new 18-month highs. Mortgage rates rose to their highest level in nearly a year, with the 30-year fixed rate hitting 6.58%. Some economists now predict that nearly 7% of U.S. mortgage rate looms. The pace of inflation had been cooling in June as energy prices declined during the temporary ceasefire, and Americans showed a modestly improved mood about the economy earlier this year. The Dow Jones Industrial Average and S&P 500 both lost around 1% Thursday, while the NASDAQ was down more than 2%. As investors fretted over runaway spending on artificial intelligence by big technology firms. Prices at the pump have made a U-turn. The national average retail price of unleaded gasoline pushed back above $4 a gallon this week, taking a bigger bite out of Americans' wallets. Meanwhile, diesel prices have been rising even faster than those for gasoline or crude oil. Diesel, which fuels trucks, construction equipment, and farming implements, tends to have an even greater impact on the economy and inflation when its price rises. The national average retail price was about $5.21 Thursday, up 39% from a year ago, according to AAA. For months, Trump has been frustrated by high oil prices, which his aides privately fear could hurt Republicans in the midterm elections, according to people familiar with the matter. The president told advisors in June that they needed to pressure gasoline retailers and oil companies to reduce prices, according to people familiar with the matter. And administration officials have discussed various ways they could seek to lower prices, including exerting additional pressure on the energy industry. The chiefs of the U.S.'s biggest oil companies, including Chevron, ConocoPhillips, and Occidental Petroleum, are in regular contact with the Trump administration about the upheaval in energy markets, according to people familiar with the matter. Their attitude in calls with the administration, one of the people said, is essentially, you can't have it both ways. If there's a war in the Middle East and the Strait of Hormuz is effectively closed, prices are going to be high. Meanwhile, shares in major air carriers slid on Thursday as American Airlines and Southwest Airlines tempered their guidance for the year to reflect oil prices march higher. Just 3 weeks ago, American expected its full-year pre-tax income to approach $1.5 billion. The company's new forecast that it will break even at the midpoint of its updated guidance range sent shares tumbling more than 8%. Airlines have passed along much of their added jet fuel costs by raising fares. Passengers have so far been willing to pay more, but volatile fuel prices could still dent corporate performance. Even in an environment of strong demand and cost controls, fuel volatility can erode the already thin margins to negative territory quickly. Connor Cunningham, an analyst with Melius Research wrote in a note to clients. The S&P 500 energy sector has whipsawed between large gains and losses since the war in the Middle East began, closely tracking oil prices. The energy-hungry industrial sector has mostly moved in the opposite direction, though a sharp climb in defense contractor stocks sent it surging on Thursday. And moves in the bond market show investors expect oil's surge to drive interest rates higher. Investors bet on inflation by buying and selling both ordinary U.S. Treasuries and those that hedge the risk of inflation, called Treasury Inflation Protected Securities, or TIPS. The gap between the yields of these two types of bonds, known as the break-even rate, has been relatively steady, suggesting that investors expect annual inflation to average around 2.3% over the next decade. Still, yields on both types of treasuries have been rising sharply together, with 10-year TIPS yield hitting its highest level since 2023, according to TradeWeb. The yield on the benchmark 10-year U.S. Treasury note also topped 4.7% on Thursday, its highest intraday level in 18 months, before the start of President Trump's second term. The moves show investors are concerned that the Federal Reserve will need to raise interest rates and keep them higher for longer to ensure that inflation remains in check. Given what's happened in just recent days with the 10-year Treasury, I think mortgage rates will get closer to 7% in the coming weeks, said Mark Fleming, chief economist at First American. ECB keeps rates steady despite inflation pressure, by Chelsea Delaney. The European Central Bank held interest rates steady Thursday, but left the door open to raising borrowing costs again in the coming months to contain inflation driven by the war in the Middle East. The central bank left rates at 2.25%, as markets expected, after lifting them for the first time in almost 3 years in June. Global oil prices have jumped back above $100 a barrel as tensions escalate in the Strait of Hormuz, reigniting the risk of war-induced inflation pressures. The ECB's pause gives policymakers time to assess how the collapse of the June U.S.-Iran ceasefire will affect inflation. Renewed fighting has sent oil and natural gas prices back up, threatening to drive inflation farther away from the ECB's 2% target. Consumer price growth in the Eurozone eased to 2.8% in June, from 3.2% in May, after the ceasefire initially drove down energy prices. ECB President Christine Lagarde said some members of the ECB's governing council discussed raising interest rates again at this week's meetings. There were some governors who asked themselves whether we should not consider a hike, she said. We all unanimously decided that we were positioned adequately to wait. European bond yields have surged along energy prices, sending government borrowing costs to their highest levels in more than a decade. Germany's 10-year government bond yield climbed toward 3.2% this week, the highest since 2011. France's benchmark borrowing costs topped 4%, a level last seen in 2009. The ECB has moved faster to confront energy price-induced inflation than the Federal Reserve or the Bank of England, which have yet to raise interest rates since the war started in late February. Investors mostly expect the Fed and BOE to hold rates steady when they meet next week. The ECB has more room to lift borrowing costs because its benchmark policy rate sits more than a percentage point lower than its peers, and is still within a range that many economists view as neutral for the economy, neither stimulating nor restricting growth. The Fed's target policy rate range is 3.5% to 3.75%, while the BOE's bank rate is 3.75%. Investors are pricing in nearly 2 more quarter-point rate increases from the ECB this year, with the next expected in September or October, according to derivatives markets. Lagarde said higher energy costs have fed through to prices for other things such as transportation. Policymakers are focused on whether elevated inflation is leading to so-called second-round effects, such as higher wages, that are harder to contain. You are listening to to a reading of articles and features from the Wall Street Journal on the Niagara Frontier radio reading service. Turning to the opinion pages, Potomac Watch by Kimberly Strassel, How to Lose Friends and Alienate People by J.D. Vance. Over many years of writing pieces critical of politicians, my Republican targets mostly took the beatings like men, many going so far as to acknowledge, if only in confidence, that they probably deserved it. Not so Vice President J.D. Vance and his dreary band of online enforcers. This egotism, or rather insecurity, is worth analyzing. This column reported last week on the bitterness Mr. Vance's congressional colleagues are feeling over his continual absence. In recent administrations, governing majorities have come to rely on the Vice President, who is ex officio Senate President, to act as primary liaison between the White House and Congress. Mr. Vance has blown off this important, if unsung, duty, preferring to stay in the spotlight. Tempers hit a boil last week when, at a pivotal legislative moment, Mr. Vance canceled a planned Tuesday House meeting in favor of appearing on the Joe Rogan Experience, where he bashed Congress. Republicans have mostly held their tongues on Mr. Vance out of deference, but the Vice President has shown a lot of lefty leg lately, undermining Israel, panning free markets, touting a Christian-themed big government agenda. That's in addition to what many Republicans view as Mr. Vance's naive approach to Iran. That elected Republicans were joining conservative commentators in a Vance rethink was worthy of reporting. And most readers would have seen the column for what it was, part of a growing GOP debate over who should lead the party in 2008. Team Vance saw it as any slight, and all hands, as it sees any slight, and all hands call to delegitimize a critic, to brand her a rhino, establishment, a liar, a captive tool, or part of some anti-JD up. The Vance press team contacted my editors to demand corrections. They wanted a mea culpa for what I didn't write, namely that Mr. Vance had showed up to the House on Wednesday. Never mind that Congress's anger stemmed from Mr. Vance's decision to ditch them for Mr. Morogan's program. They claimed that wasn't the reason for canceling, though they didn't provide an alternative explanation. What else was Mr. Vance doing in Austin, Texas? Their final complaint was a hair-splitting gotcha. I wrote that lawmakers can count on a few fingers the times former Senator Vance has set foot in the Capitol. That's what lawmakers told me. Mr. Vance's spokesman insisted the Vice President had been there more than 24 times since taking office. The phrase obviously referred to the infrequency with which Mr. Vance huddled with members of Congress to solve problems and wasn't a literal count of the number of times he was physically present to attend a speech or break a tie. Mr. Vance's real bully boy strength shows up with his online army, where a retinue of, quote, influencers and, quote, journalists stand ready with an arsenal of labels, whataboutisms, and falsehoods. The tactics aren't new. They're straight up Saul Alinsky. Pick the target, freeze it, personalize and polarize it, long practiced by the left. I wrote a whole book about that, The Intimidation Game. What is new is for the right to use such means in an effort to shut down conservative dissent. Even as Mr. Vance's team complained I'd omitted the word Wednesday, his deputy chief of staff went online to claim, falsely, that I, part of the left, had written that Mr. Vance was, quote, nowhere to be seen on, quote, Tuesday or Wednesday, end quote, above a picture showing the Vice President in Congress on Wednesday. That was the cue to a swarm of Mr. Vance's social media minions. They labeled me a spineless leftist. Their proof of series of lame rejoinders. Yeah, but the Senate sucks. Yeah, but what about Mitch McConnell? Yeah, but you probably don't even like the Save America Act. Yeah, but you're a loser. Most telling was how this crew operates. As to how this crew operates was the Federalist Sean Davis, who accused me of, quote, pulling an obvious little stunt against Mr. Vance, whose wife just gave birth. This appeared above my headline, President Vance Goes AWOL. The implication was that I'd criticized the Vice President for taking a day of paternity leave. But as Mr. Davis knew, Usha Vance didn't bear little Alec, mazel tov, until 5 days after Mr. Vance's controversial absence. What Mr. Davis also knows is that online mobs don't check facts, and he got his desired result. Hundreds of posts slanging me as not just a traitor, but an unfeeling ass. Also as a deep state, Marxist, liberal, corrupt, billionaire lackey, an intellectually dishonest, uniparty mouthpiece who is little more than a scumbag propagandist and anti-Trump who lives for the donor class. If they think that's bad, they should hear what my kids call me. Can Mr. Vance possibly think this is smart? Successful politicians seek to find new allies, not to alienate long-standing ones, whether elected colleagues, interest groups, the entrepreneurial class, or conservative media. Winning is hard enough without a right-on-right cage match. One answer is simply that Mr. Vance is a sensitive bunny. If he wants to be president, he'll need to get over that. But the other answer is that Mr. Vance knows his, quote, national conservative, end quote, ambitions for the GOP aren't landing. Republicans are increasingly up in arms over a Vance agenda that sounds like Bernie Sanders. Hence, his Vance teams need to invalidate anyone who disagrees as a rhino or a tool of special interests or an elite, the better to allow them to define what counts as a real Republican, a Vance Republican. Here's an idea. Make the argument instead, and maybe let others make theirs too, free of the gaslighting. In Review and Outlook, the surprise billing racket. Congress measures success by what it passes, not by the results of what it passes. A classic example is the No Surprises Act of 2020, which has had consequences nearly the opposite of what was intended. Read on and weep. Surprise medical bills were the outrage du jour before the pandemic. And in 2019, President Trump leaped in. For too long, surprise billings, which has been a tremendous problem in this country, has left some patients with thousands of dollars of unexpected and unjustified charges for services they didn't know anything about. Surprise bills usually resulted from patients who receive emergency care at hospitals outside their insurance network or at in-network hospitals that contract with out-of-network providers. Hospitals sometimes employ outside provider groups that can be less expensive than putting physicians on their payrolls. As Congress considered arbitration legislation, insurers and provider groups clashed. Insurers wanted Congress to require arbitrators to peg payments to out-of-network providers to their in-network rates. Provider groups called this unfair. Congress finally attached the No Surprises Act to its December 2020 COVID spending splurge. Providers won. Insurers and their customers lost. The legislation ended surprise bills but swelled costs for insurers, which are now being passed along in higher premiums. The law established baseball-style arbitration to resolve payment disputes between out-of-network providers and insurers. Third-party arbitration companies certified by the Centers for Medicare and Medicaid Services, CMS, are required to choose between payment rates proposed by the patient's insurer and the provider. No splitting the baby. Arbitrators last year ruled in favor of providers in nearly 90% of cases. Large provider groups on average win payments that are 3 to 9 times in-network rates. One reason that they can choose which CMS-certified arbitration company reviews their claim. No surprise, they funnel claims to those that rule in their favor. Arbitrators also have a strong incentive to rule for providers to attract more business. Arbitrators set their fees, typically about $600 per claim, which are paid by the losing party. Ruling for providers encourages them to file more claims. No surprise, claims have exploded. In 2021, Biden officials projected that 17,000 disputes would go to arbitration every year. Last year, there were 2.6 million, and claims keep rising. Claims against Elevance Health increased 30% between last year's fourth quarter and this year's first. Insurers have challenged about 40% of claims by providers as ineligible for arbitration under the No Surprise law, usually because they involve elective procedures. But arbitrators don't often throw out ineligible claims. Why not? Because they don't get paid unless they issue a payment determination. providers are winning huge payouts for ineligible claims, which encourages them to file more claims seeking bigger payments. The riches that can be made have discouraged providers from joining insurer networks, which ironically was one of the surprise billing law's goals. Planned procedures, not emergencies that the law was designed to address, account for the bulk of insurer payouts. Elevance says plastic surgeons seek $100,000 on average for breast reduction surgeries, while its in-network providers are paid $2,000 to $5,000 on average. Medicare pays only $1,500. One Connecticut practice is obtaining awards of roughly $440,000 for the procedure. In New York, podiatrists are filing claims averaging $30,000 for hammer toe surgeries. Medicare pays roughly $400 for the procedure, and in-network providers get $700. Doctors who remotely monitor patients' nervous systems during surgeries, often from their homes in other states, have joined the racket. In several markets reviewed by Elevance, surgeons performing spinal procedures are typically reimbursed $7,000 to $12,000, while out-of-network neurologists remotely monitoring them are winning upwards of $40,000 in arbitration. One provider sought $9 million in a single year for remote neuromonitoring services. A lucrative cottage industry has developed around this system. Medical billing companies, the most prominent is Halo MD, submit claims on behalf of providers and take a cut of provider rewards. The owners of Halo MD also run a neuromonitoring service. Private equity firms own some of the top billing providers, including Team Health, SCP Health, and Radiology Partners. They also are financing arbitration companies. Don't blame private equity for exploiting the perverse incentives that Congress created. Hard to believe, but Democratic-run states are doing a better job of limiting arbitration abuse. Between May 2024 and May 2025, Virginia's arbitration system for fully insured commercial plans, enacted by Democrats in 2020, handled 252 cases, compared to more than 34,000 Virginia cases that were filed in the federal system. Democrats in New York recently capped provider payouts under their state system. The reforms came after state officials discovered that arbitration abuse was costing its state employees' health plan more than $200 million. This abuse, quote, is a primary contributor to the nearly 10% increase in premium rates this year, end quote, the state said. Insurers are begging Congress and the administration for help to counter abuse. One place to start would be for CMS to audit and decertify arbitration firms that repeatedly rule for providers on ineligible claims. CMS could also issue guidelines setting caps on payments to providers, though legislation might be required to make this stick. Alas, the Trump administration recently finalized a Biden-proposed rule aimed at making arbitration more efficient and less expensive for providers. This will encourage more claims. The surprise billing fiasco is typical of how the government works, or, more accurately, doesn't. In letters, Colonel Jeffrey Parker, USAF retired of Prescott, Arizona, writes, America has a wildfire readiness problem. Your editorial, Trump and Bernie, Political Smoke Jumpers, on July 18th, rightly notes that Washington should tend its own overgrown forests before criticizing Canada. But the deeper failure isn't land management alone. It's an aviation fleet the government has let atrophy for decades and never rebuilt to match the threat. With many years of military experience, I know what happens when you ration a scarce, aging fleet against rising demand. Readiness erodes, and someone downstream absorbs the risk. In wildfire aviation, that someone is the states. The federal government's own national preparedness level system, which throttles aircraft to fires nationwide as conditions worsen, is not a first responder guarantee. It's a rationing ladder. It presumes states already have adequate initial attack capacity of their own. Washington state took full responsibility for the gap. It first mandated an aviation plan by statute, then built its funding and fleet decisions on top of that plan's findings. A model for the rest of the country is challenged to meet. The nation's large air tanker fleet has long been unstable. It shrank from roughly 44 to 8 aircraft between 2002 and 2013, even as fire seasons lengthened and intensified. Unable to fill requests during peak season aren't rare exceptions. They're the predictable outcome of a system built on assumptions nobody has fully updated in 20 years. When your home is burning and the local fire department doesn't show up, it burns down. Multiply that by orders of magnitude when a wildfire crossing an urban interface is left unchecked. Congress and state legislatures, not editorial pages, should be arguing over that math. You're listening to a reading of the articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Also from Review and Outlook, the Congressional Stock Trading Meme. Congress's anger entrepreneurs are, who would have guessed, honking upset. For months, they've raged that the Capitol is full of legislators making corrupt fortunes from insider trading in the stock market. This isn't reality. But the House responded to public concern Wednesday by passing, in a 232 to 198 vote, a bill called the Stop Insider Trading Act. As a reminder, Congress is already banned from trading on non-public information by the 2012 Stock Act. Transactions of more than $1,000 must be disclosed. Serious allegations can be investigated by the FBI, yet in some quarters it's taken for granted as a social media truth that Congress is obsessed with day trading at the public's expense. For the record, less than half of the Senate and only a third of the House held shares in individual companies in 2024, the Journal reported. News headlines about shout scandal, often mistakenly. Last fall there was a story about trading by Pennsylvania Representative Rob Bresnahan. On May 15th, according to NBC, he dumped 6 figures worth of stock in a quartet of companies that manage nearly half of all Medicaid enrollees. A week later, he voted for the One Big Beautiful Bill, which reformed Medicaid. The insinuation was, well, what? The Medicaid reforms were hotly debated, no insider secret. Mr. Bresnahan told NBC he never instructed my financial investors on what to buy, sell, or hold. His disclosures showed all sorts of transactions, including sales of PepsiCo and purchases of Kraft Heinz, consistent with a professional portfolio management. The Medicaid stocks he allegedly dumped included CVS Health, a big diversified firm whose shares are up about 68% since May 2025. Mr. Bresnahan voted yes on Wednesday's bill. The point is to be wary of argument by anecdote, since the trading database is a big haystack and journalists are pattern-seeking animals. One academic study of Congress's trading disclosures from 2012 to 2020 found no evidence that lawmakers overall beat the market. House and Senator stock returns are consistent with random stock picking. Voters are also free to fire any politician they regard, fairly or not, as conflicted or distracted. All of this counsels caution, which the Stop Insider Trading Act reflects. The bill would let Congress keep existing individual stocks but prohibit lawmakers, spouses, and dependent children from buying new shares. Before selling current holdings, they'd have to give 7 days of notice, which addresses the concern that lawmakers might quickly offload assets after receiving some grim briefing. Yet once the populist fires get burning, they can be hard to douse, and progressives are calling Wednesday's bill a sham because it doesn't ban all congressional stock ownership. Joined by some on the right, they want Congress, spouses, and children to liquidate all stock holdings in individual companies in 180 days. No exceptions for blind trusts. Parking money in index funds and broad investment is wise for most lawmakers. The populists effectively want to take away the public's right to elect exceptions. The danger is that an inflexible rule would deter successful business people from seeking office. What if a good potential candidate has a husband in finance, or wants to serve a term in retirement but not at the cost of an asset fire sale? Congress needs more people, not fewer, with experience in business. Progressives want to clear out that type of lawmaker. There are too many millionaires in office, Socialist Representative Alexandria Ocasio-Cortez said last fall, and making them liquidate can even the playing field. She wants a Congress populated by nonprofit lawyers and community activists. Why should the GOP help with that? The Stop Insider Trading Act is best understood as an attempt to forestall greater populist nonsense. But no one should expect it will somehow make Congress more ethical. It will mainly make it safer for lawyers and career politicians. The cartoon, Pepper and Salt, shows people sitting around a table and saying, "Won't having a budget give us false hopes?" Looking at the business and finance section, in Earnings Watch, profits fall on fuel prices and demand. Takeover target EasyJet reported a drop in pre-tax profit for its third quarter, as results were dragged down by higher fuel prices and lower demand due to the Middle East conflict. The airline said pre-tax profit, which strips out exceptional and other one-off items, fell to £85 million, or $113.7 million, for the quarter from £286 million a year earlier. Revenue grew to £2.98 billion from £2.92 billion, while passenger revenue fell to £1.74 billion from £1.76 billion. Passenger numbers fell to 25.8 million from 25.9 million, while load factor, a measure of how full its planes are, dropped to 88.9% from 90.2%. As consumer confidence increases, we are seeing the load factor gap close for peak summer, Chief Executive Kenton Jarvis said. The airline also said Chief Operating Officer David Morgan would step down to be succeeded by Chief Commercial Officer Sophie Dekkers. This month, EasyJet received a $7.6 billion takeover bid from Apollo, trumping an earlier agreement of around $7 billion with Castle Lake. By Nina Keenly. Connor Hart reports for Harley-Davidson, strong sales spur increase in outlook. Harley-Davidson said it expects to sell more motorcycles this year than it previously expected after reporting strong North American sales in the second quarter. The company posted net income of $79.8 million in its 3 months ended June 30th, down from $107.6 million a year earlier. Quarterly earnings of 75 cents a share topped the 64 cents a share that analysts polled by FactSet expected. Total revenue fell 5.9% to $1.23 billion, but came in ahead of Wall Street models for $1.17 billion. Global retail motorcycle sales ticked up 0.5% to roughly 42,500 units, reflecting North American growth and soft international results, the company said. Our second quarter performance reflects strength in our domestic retail business, continued focus on healthy dealer inventory levels, and the exceptional commitment of our dealer network, Chief Executive Artie Starrs said. Harley-Davidson now expects global motorcycle retail sales of 133,500 to 138,500 units for the year, compared with a prior outlook of 130,000 to 135,000 units. Albertsons Grocers predicts weaker sales. Albertsons expects sales to weaken this year after its core grocery business struggled in the last quarter. Shares slid 22% to $11.44 on Thursday. For the year, the grocery store chain expects identical sales to fall 0.5% to 1.5%, compared with a prior expectation that annual sales would be flat up to 1%. Adjusted earnings per share are now projected to be $1.75 to $1.85, down from $2.22 to $2.32 previously. Quarterly profit fell to $84.7 million, or 17 cents a share, compared with $236.4 million, or 41 cents a share, a year earlier. Stripping out certain one-time items, adjusted per-share earnings were 42 cents, below the 54 cents anticipated by analysts, according to FactSet. Revenue rose less than 1% to $24.94 billion. Analysts had forecast revenue of $24.83 billion. Identical sales fell 0.8%. This was by Catherine Hamilton. And Kwan Yu Jun says Hyundai Motor cooling sales dent automaker's profit. Hyundai Motor recorded weaker second quarter net profit as vehicle sales declined amid cooling global demand. Hyundai's unionized auto workers in South Korea are staging partial walkouts for a second week to demand higher wages. The union is also seeking job protections amid advances in artificial intelligence and robotics, opposing management's plan to begin deploying humanoid robots on assembly lines within 2 years. Hyundai, South Korea's largest car maker, said net profit for the April-June period declined 11% from a year earlier to 2.888 trillion won, equivalent to $1.96 billion. Revenue rose 1.9% to a record 49.215 trillion won, while operating profit fell 21% to 2.851 trillion won, weighed down by sluggish car sales, higher raw material costs, and supply disruptions. Brisk demand for hybrid vehicles and favorable foreign exchange rates helped sustain revenue growth despite lower overall vehicle sales during the quarter, Hyundai said. The car maker earlier this month said it would acquire SoftBank's remaining stake in its U.S.-based robotic unit, Boston Dynamics. Hyundai has said it plans to deploy Atlas humanoid robots at its Georgia megaplant starting in 2028. The company aims to build a factory capable of manufacturing 30,000 robots annually. In February, Hyundai unveiled a multi-billion-dollar investment plan to advance physical AI in South Korea. American Airlines cuts guidance as fuel prices surge by Dean Seal. American Airlines said it is on course for an adjusted loss in the current quarter after the latest surge in jet fuel prices. The carrier on Thursday said revenue is projected to rise 16% to 19% in the third quarter, but that it's on track to post an adjusted loss of 10 to 70 cents a share. Analysts polled by FactSet had been forecasting an adjusted profit of 26 cents a share. Given the recent jump in fuel costs from the continuing war in Iran, Americans said its bottom line for the full year would be somewhere between an adjusted profit of 65 cents a share and an adjusted loss of 65 cents a share. That is down from a previous target of between an adjusted loss of 40 cents a share and adjusted earnings of $1.10 a share. America's stock slid 8.4% to $13.56 in Thursday's trading. Airlines have been getting hammered this year by soaring jet fuel prices, which hit records of more than $4.80 a gallon in April, according to the Argus U.S. Jet Fuel Index. After recovering to about $2.81 a gallon in early July, prices shot back up after the U.S.'s ceasefire with Iran collapsed this month. As of Wednesday, the spot price of jet fuel was $3.65 a gallon. Carriers have raised prices to offset their rising costs. American said revenue in the second quarter climbed 16% to $16.74 billion, ahead of analyst estimates. Demand was strong, and revenue rose across its premium, main cabin, domestic, and international seats. Higher fares helped American mitigate nearly half of the impact of an 83% increase in fuel costs, the company said. The company logged a quarterly profit of $71 million, or 11 cents a share, compared with $599 million, or 91 cents a share, in the same quarter a year earlier. Stripping out one-time items, adjusted earnings were 15 cents a share. Analysts had been looking for just 3 cents a share, according to FactSet. Volume growth lifts earnings. Union Pacific reported higher profit and revenue in the second quarter, boosted in part by volume growth. The freight company posted profit of $1.99 billion, or $3.36 a share, for the quarter ended June 20th, up from $1.88 billion, or $3.15 a share, a year earlier. Stripping out one-time costs, earnings came in at $3.41 a share. Revenue climbed 12% to $6.86 billion. The readout came a day after Union Pacific reached a deal with Canadian National Railway, giving the Montreal Railroad further access in the Midwest in exchange for ending its opposition to Union Pacific's $71.5 billion merger with Norfolk Southern. This was by Connor Hart. You're listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. T-Mobile revenue ticks up as account growth slows by Kelly Clunan and Molly Reinman. T-Mobile US's profit and revenue grew in the latest quarter, boosted by its postpaid business, but new account additions have begun to slow. Still, the cell carrier maintained its forecast for profit and postpaid net account adds for the full year. Second quarter profit came in at $3.24 billion, or $2.99 a share, compared with $3.22 billion, or $2.84 a share a year earlier. The recent quarter's figure includes merger-related costs from T-Mobile's acquisition of U.S. Cellular. Revenue rose 7.9% to $22.79 billion. The growth was fueled by higher postpaid service revenue, up 13% a year over year to $15.85 billion, as T-Mobile continued to add postpaid accounts and earn more revenue from each of them. The Bellevue, Washington company's postpaid phone service is its most lucrative phone offering, where service is paid for each month on a contract. Comcast profit falls, but subscriber losses narrow, by Elias Schischel. Comcast reported a lower profit in its second quarter, but narrowed subscriber losses in its domestic residential broadband business for the second quarter in a row. The cable and entertainment company said it lost about 167,000 domestic residential broadband customers during the second quarter, wider than the 165,000 analysts polled by FactSet were expecting, but below the 201,000 it lost a year earlier. The company attributed the narrowing to the effects of its new go-to-market strategy. Comcast posted a profit of $3.53 billion, or 99 cents a share, compared with $11.12 billion, or $2.98 a share a year earlier. Stripping out certain one-time items, the company reported adjusted earnings of $1.04 a share. Analysts were expecting 97 cents a share. Revenue fell to $29.94 billion from $30.31 billion. Analysts were expecting $29.24 billion in revenue. Comcast narrowed its loss of domestic video customers, shedding 280,000 compared with 325,000 a year earlier. Analysts were expecting a loss of 277,000 customers. The company added 448,000 domestic wireless lines during the quarter, outpacing the 379,000 analysts were expecting. Revenue from Comcast's domestic broadband service fell 5.5% to $6.28 billion, while domestic wireless service revenue rose 14% to $1.01 billion. Media revenue rose 25% to $5.69 billion, of which the company attributed about $441 million to gains from the FIFA World Cup. Its Telemundo network and Peacock streaming service held the U.S. Spanish language rights to the tournament. Peacock reported a 54% increase in revenue from the prior year period to $1.9 billion. The company ended the second quarter with 48 million paid Peacock subscribers, compared with 46 million in the first quarter. Nestle sells half of its waters business, by Amy Look. Nestle agreed to offload half of its water unit, Home to Perrier and San Pellegrino, to private equity group Platinum Equity in a $3.4 billion deal as it continues to shoulder hefty costs from its restructuring efforts. The Swiss consumer goods company said it would create a joint venture with billionaire Tom Gore's Platinum Equity and shed a 50% stake in its waters and beverages business for 3 billion euros in cash, or $3.42 billion. The new business, called Perenel, is valued at 4.9 billion euros, including cash and debt, with the deal expected to close in the first half of next year. The agreement is the latest step in a restructuring push that drove up costs in the first half of the year, weighing on profits. The maker of Kit Kat chocolate bars and Nescafé coffee said in its results that net profit for the period was 3.47 billion Swiss francs, or $4.26 billion, missing company compiled analyst estimates that the figure would remain relatively unchanged on year at 5.07 billion francs. Nestle's shares fell 7.8% on Thursday. The company previously indicated it was aiming to sell a few brands. In February, Nestle said it would shed its remaining ice cream business into a Fronnery joint venture, in which it keeps a 50% stake. Nestle has also been seeking buyers for Nature's Bounty and other brands in its vitamins business as a way to improve sales growth, pivoting toward higher-end products such as Solgar and Garden of Life. On Thursday, Nestle said it expects to sell mainstream and value brands within its vitamins arm by the first half of next year. The loss on the disposal of the segment is expected to be around 1.3 billion francs. Chief Executive Officer Philippe Navratil is undertaking an overhaul of the maker of Nescafé coffee and Purina pet food in a bid to steady the ship after a string of setbacks, underperformance, and management upheaval in recent years. His efforts since taking the helm in September have focused on slimming down its sizable portfolio, mirroring moves by rivals in the sector. Nestle says it is cutting around 16,000 jobs, has sold off brands, and is reorganizing the business around 4 main categories: coffee, pet care, nutrition, and food. Other consumer goods businesses have also been aiming to get leaner. Dove soap maker Unilever spun off its ice cream businesses last year into the Magnum Ice Cream Company and struck a deal with spice maker McCormick to combine food businesses. Similarly, UK sugar-to-clothing company Associated British Foods said it was separating budget fashion retailer Primark from its food arm. Nestle's organic sales in the second quarter, also reported Thursday, rose 3.7% on year. The result was driven by pricing, which was up 1.9%, while growth in sales volumes, called real internal growth, was 1.8%. Overall sales were 21.79 billion francs for the second quarter, compared with 21.63 billion francs a year earlier, and analysts' expectations of 21.71 billion francs, according to company-compiled estimates. Google discloses a 6% stake in SpaceX by Catherine Hamilton. Google said it owns $94.1 billion in SpaceX shares, a roughly 6% stake in the newly public company. The tech conglomerate's marketable equity securities include $80 billion in SpaceX shares, subject to short-term restrictions on the ability to sell, and $14.1 billion of shares subject to long-term restrictions through the third quarter of 2027, according to a quarterly filing published Thursday. The restrictions are common for shareholders that buy stock around the time of an initial public offering. SpaceX debuted on the public markets in June, marking a blockbuster IPO, which NASDAQ said earlier on Thursday was its biggest listing in history. SpaceX stock rose 19% to $135 on its first day of trading, June 12th, giving the company a market value of $2.1 trillion. The stock price has edged lower over the past month. SpaceX shares closed about 2.6% higher Thursday. Based on SpaceX's market capitalization of $1.52 trillion on July 23rd, Google has a roughly 6% stake in the space and AI company. Google has had a long history of investing in SpaceX. In May, the two companies were discussing a rocket launch deal to help develop orbital data centers, the Wall Street Journal reported. Google has been expanding its effort to put orbital data centers in space as it ramps up its AI development, and SpaceX chief executive Elon Musk has expressed interest in the unproven technology. And in U.S. news, the Department of Justice is to withdraw subpoenas for New York Times reporters by Corinne Ramey. The Justice Department on Thursday said it would withdraw subpoenas related to several New York Times reporters' recent articles after a federal judge grilled prosecutors over whether they had followed proper procedures for the criminal investigation. The judge, Arun Subramanian, questioned prosecutors about the subpoenas, which were ordered after the Times published 2 articles this month about a jet gifted to the U.S. by the Qatari government that was being used as Air Force One. Issuing subpoenas to reporters, Subramanian said, carries a high legal bar. They are the last thing you do, the judge said. It's a matter of basic compliance with the law. Sean Buckley, a lawyer for the Justice Department, argued there was an exception if a subpoena is authorized by the Attorney General. Acting Attorney General Todd Blanche said at his confirmation hearing before the Senate Judiciary Committee last week that he authorized the journalist subpoenas. The day after the second article was published, armed federal agents served 3 reporters with subpoenas at their homes, the Times lawyers said. They also attempted to serve subpoenas to 2 other reporters, but didn't do so. The Justice Department subsequently ordered a second set of subpoenas for phone records, some of which were tied to relatives of the reporters. Buckley said prosecutors had obtained the phone numbers from a law enforcement database and hadn't intended to seek records of family members. That was an error, Judge, which we own, Buckley said. It was a consequence of trying to move quickly. Lawyers for the Times filed motions to quash all the subpoenas. They argued the subpoenas didn't meet the legal test for compelling information from a reporter. They also said the requests for phone records, quote, demonstrate abuse of the grand jury process, continued bad faith attacks on the journalists, end quote, and violate Justice Department regulations. From the beginning of the hearing in a Manhattan federal court, Subramanian made clear that he planned to quash the subpoenas if the Justice Department didn't opt to withdraw them. At one point, he called up a prosecutor sitting in the courtroom gallery and questioned why he had told a judge, after the investigation had been the subject of public reporting, that the probe wasn't public or known to the targets of the investigation. The prosecutor, Kevin Sullivan, said the reporters weren't targets. The judge then asked why prosecutors requested the subpoena for phone records remain confidential. Are you going to do this again? Subramanian asked. No, Your Honor, said Sullivan. Absolutely not. A Times spokesman said it was pleased the Justice Department agreed to withdraw the subpoenas, quote, but they should never have been issued in the first place, end quote. A Justice Department spokeswoman said the investigation remains ongoing. She accused the judge of, quote, blocking the grand jury from receiving core evidence in a national security investigation, end quote. The Wall Street Journal and its reporters received grand jury subpoenas dated March 4th that sought information related to a February article about the Pentagon raising concerns to Trump about the risks of an extended military campaign against Iran. A Dow Jones spokesperson said the subpoenas were later withdrawn. You've been listening to a reading of articles and features from the July 24th issue of the Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. and Friday at 6 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have the Buffalo Criterion. At 8 o'clock, we have the New York Times. And at 9 o'clock, we have Discover Magazine. Stay with us for these readings and more. following program is intended for listeners who are blind, have low vision, or have another print disability